Google was supposed to be dead. At the beginning of 2025, investors thought AI was coming for Google's search business. People thought ChatGPT would destroy them. The government was trying to force them to sell Chrome, and the stock was trading like one of the greatest companies in the world had suddenly lost its future. By the end of the year, the story had completely changed. Google kept search growing, cloud accelerated, Gemini became a real competitor, YouTube kept dominating, Waymo went mainstream, and the company crossed its first $100 billion revenue quarter. This is a story of how bad sentiment can hide a great business. Google was formed after two freak-of-nature type smart people came together at the exact right time to create something that fundamentally changes the world. The types of people who history writes about later on as being inherently different than the rest of us. Certainly smarter than me. 30 years ago, Sergey Brin and Larry Page met, and they hated each other. It's not a joke. In 1996, they met at Stanford University, and all day they argued about every subject imaginable. They couldn't see eye to eye at all, but apparently found each other intellectually stimulating, and they started sort of a nerdy bromance. They realized that they could change tech forever. Put simply, they decided to download and organize the internet for all of us. There were search engines at the time, but they were terrible. Anyone who grew up in the 90s remembers the mess that was the internet. By 1999, these two frenemies had secured $25 million in funding, and by year 2000, they were already the world's largest and best search engine. They took the chaos of the internet and they made it organized and simple. By 2004, the company was a worldwide verb, and they went public at a valuation of $23 billion. At just 30 years old, these two men were instant billionaires. From there, the company just continued to grow. They rode the wave of the internet boom, kept building, innovating, acquiring, and ultimately becoming one of the biggest and most important companies in the world. Google is synonymous with the internet. Google is a resilient and smart company. $1 spent on their stock in 2004 when they went public is roughly $170 today. The company has almost never had bad years, and when it does, they're minor blips. The 2008 financial crisis was really the only year that the company saw things go south in a significant way. That is, until 2022. 2022 was not a good year for Google, or at least it wasn't a perceived good year. Let me explain. To the average onlooker, it seemed really bad. Most big companies were experiencing a bad year due to global issues like the war in Ukraine, but something else happened for Google. A small company called OpenAI launched a chatbot that would change the world. ChatGPT launched to massive success. In the same way that Larry and Sergey turned the chaos of the internet into organized data, Sam Altman was the first one to turn the chaos of large language models into organized and intelligent systems. Larry and Sergey organized the data, Sam Altman gave it reasoning. Investors panicked and began to sell their shares of Google. How could a search engine survive when something so much easier exists? In a period of just 13 months, Google lost almost half of its value, going from $2 trillion all the way down to $1.15 trillion by the end of 2022. Experts and analysts were sounding the alarms. People were done with this company. Google seemingly was in terrible trouble. People were more and more sure every day that AI would destroy search rather than enhance it. Google released their own chatbot to compete with ChatGPT, and it launched with terrible results. On top of all of this, there was fear in the market that Google Chrome was a monopoly. By 2024, a US district judge ruled that Google had illegally maintained a monopoly in search, and the Department of Justice officially recommended that the judge force Google to divest the Chrome browser. Google Chrome is rarely understood in terms of its importance to the company. It's a free product. It brings in no official revenue for the business, but it's their gateway to user data, which is crucial for their ad targeting with search. 3 billion users around the world tell Google how they interact with the internet by using this free product. Google can then take that data and feed those users ads that are most likely to make them click and ultimately purchase. To put in perspective how valuable it is for Google to have users on their browser, Google pays Apple an estimated $20 billion per year to be the default search engine on Safari. Google Chrome is at the center of roughly 55% of the company's revenue. Without this asset, it's believed that the company would have to pay an additional $20+ $6 billion per year to whoever owned the dominant browser. Imagine you're building a company for 17 years. The whole time you're growing your sales team. You build out the processes, scripts, continually train your best sales reps, get sales directors, and for years figure out what works and what doesn't. After 17 years, you have an incredibly streamlined process for predictable revenue and sales growth. Your cost is exactly what you decide with your professional team. Then a US district judge decides that your sales force makes your company a monopoly. You have to sell the whole division of your company to create a separate entity, after which you have to pay them the price that they decide as a new company for the service that you built. That was the unjust situation that Google found itself in back in 2024. From Google's point of view, Chrome was part of a system that it built. From the government's point of view, that system made it too hard for anyone else to compete. This brings us to 2025, the year that changed everything. A lot of things went right for Google in 2025, but the main ones can be broken down into these 5 categories. Number 1, Google won the battle for Chrome. Interestingly enough, one of the main reasons that Chrome was ultimately not considered a monopoly was because of the rise of ChatGPT as a competitor. With massive irony, if ChatGPT had never come about, then Google would likely have lost Chrome. Number 2, Google Cloud growth began accelerating while simultaneously becoming more profitable. Number 3, Gemini became really good. And I mean really good. If you use AI a lot, then this is a shift that you probably noticed. Not only did Gemini become just as good as ChatGPT, but in many ways it has outpaced it, providing more factual answers, less hallucinations, and more advanced reasoning. Number 4, the first $100 billion quarter, which was Q3 of 2025. This was a psychological milestone for the market, unequivocally showing that Google not only isn't going down without a fight, but it's actually thriving in the world of AI. Then number 5, Waymo goes mainstream. Much to the dismay of Tesla, Waymo has beaten them to the punch for the fully autonomous robotaxis. Though currently very small in terms of actual revenue for the company, there's no doubt in investors' minds that whoever scales autonomous vehicles first will ultimately become very rich. Real quick, I just want to mention my own product that I've been building. It's called The Fifth Share. Every week we break down companies like this, the fundamentals, the leadership, the risks, and the false narratives. In plain English, it's decision-grade research for regular investors. It's $10 a month, and the link's below. All of this would come as a massive surprise to anyone just reading news headlines or social media posts from anyone who doesn't have the ability of foresight. I'm actually one of those people, but I'm trying really hard to change that now because stuff like this happens all the time in business and investing. And it's those who put in the work to study data and recognize patterns who ultimately end up benefiting from turnarounds like this. From 2022 until the beginning of 2025, Google seemed like a company in distress at the very least, and to many, a company that was doomed to fail. Even big names in finance were saying the company was done. But none of this was true. If we look at the revenue from 2022, this hardly looks like a company being gutted from AI. It actually looks like a very healthy company with revenue growth far outpacing inflation. And crazy enough, that's in a time of high inflation. This graph of actual profit shows a more clear reason for the panic, and it's one of the reasons why interpreting data is so important. When looking at this graph, we see a clear drop in profitability of the company. Like we said before, 2022 was not great for Google. 2021, however, was really good for Google, and I mean really good. The world shut down for the pandemic, and that made basically all of Google's services in higher demand. If we zoom out on this graph, what do you notice about the difference between 2020 and 2021 for the company? In terms of profits, the company roughly tripled in size. That's unheard of for a company the size of Google at the time. All of that required massive hiring, extra costs, and training, which don't quite carry over to 2022 in terms of actual profitability. On top of that, the dollar was stronger than foreign currencies, so when the company made money abroad, it cut billions of dollars from the bottom line. Interestingly enough, if you look at pure profits, 2022 was still a much more healthy company than 2020 Google. But the stock price had dropped back to 2020 levels. People saw a decline in profits and they panic sold the company. This, on top of ChatGPT's rise, made the company seem like it was dying when it was actually thriving, just experiencing some minor pains. Another way to read between the lines of what's actually going on with a company is to look at the shares outstanding. If a company is buying back shares, it usually signals that the company is confident in the future, meaning that their profits are best spent in buying back shares of the company rather than putting it somewhere else. This whole time that Google was quote unquote a sinking ship, management was quietly buying back their own shares in the company at a discount. As an investor, this is often a really good sign. The price to earnings ratio is another great way to peek behind the curtains of a company. Just looking at the stock price, it looked like Google was in free fall, but historically, Google has traded at around a 30 PE ratio. In the graph shown here, the company is actually a better deal the lower the graph goes. In 2022, the PE ratio went down because earnings remained high while sentiment got worse. If we zoom out on the graph, we can clearly see that the company averages around a 30 times multiple of earnings per share. With the early days of the company being abnormally high when the stock was risky and investors were pricing in a very good future for the company. The dip seen in the first graph during 2022 would not exist if earnings had gone down at the same rate that the stock price had gone down. Google's cloud backlog tells another very important story. This is how much business is now under contract for Google to fulfill on. People in 2022 saw Google as primarily a search engine business, when in actuality, it has expanded massively outside of just search. To date, Google has acquired roughly 270 businesses. Google Cloud is one of Google's most important services and will be a major player in the company's future. Originally launched in 2008, Google Cloud has become a powerhouse for the company. Cloud in general is the future of compute. Moore's law is dead. What does that mean? It means that single device compute is much less relevant in an increasingly compute-hungry world. Put simply, the future of technology is in using your device as a conduit to access the endlessly powerful data centers fueling the world. We're seeing this in generative AI, machine learning, gaming, global security, finance, custom apps, entire platforms like streaming services and social media, and much, much more. Cloud is the future, and Google is one of the few companies in the world building out the infrastructure to handle the demand. While the stock price of Google went down in 2022, the demand and backlog grew. This graph tells a very important story. Google Cloud was actually losing money until 2023. For short-term investors, this can sound alarm bells, but for long-term investors, a rooftop bet like Google Cloud is actually a really good sign. It shows a company that is investing in its long-term future. Google went 15 years losing money while building out infrastructure and teams around a new business model. That shows incredible resilience and patience, something that's never really seen in poorly managed companies. The increase in profitability around Google Cloud is creating a very strong compounding effect that investors are now reaping the benefits of. The world is more hungry for compute, which makes the demand for cloud go up. That's the backlog. While the price of cloud goes down for the owner, that's Google, because of 18 years of investment. The result is a company that is much better positioned to profit from this wave than almost any other company on the planet, because they had decades of foresight, great talent, and intense discipline. The bottom line is increased demand mixed with increased profitability is a rare and very good signal for your company. As the world shifted through the AI revolution, most people have been caught by surprise. NVIDIA has so far profited more than anyone else because they had the technology and the foresight to see what the market needed. They gave the world GPUs capable of training AI, and within just a few short years, made every major company reliant on them. Every company except Google. Google also had this foresight and decided in 2015 to start developing their own chips. This would allow them to not be reliant on any other companies for their own critical services. On top of that, they can pay cheaper prices for their own infrastructure rather than paying the price that a vendor like NVIDIA charges. 2025 was the year that Google showed the world that it's not fully dependent on NVIDIA in the same way that other AI companies are. Its TPUs give it a level of vertical integration most competitors don't have. Other major tech companies have expressed interest in using Google's TPUs for their own needs in order to diversify and meet compute demands. Google is now the only AI company that owns the full stack, meaning the chips, the data centers, and the models. By not paying the NVIDIA tax, it's estimated that Google can increase its margins by up to potentially 50%, which is a game changer. Just by training and running AI on their own, TPUs lower Google's compute costs by potentially 80% compared to benchmarks for NVIDIA hardware. As of this recording, these numbers change often. In 2025, Apple revealed it used Google's chips to train its own AI models. Meta began talks for a multi-billion-dollar deal to lease TPU capacity from Google, and remember OpenAI, the company that was going to run Google into the ground? Even they began to rent TPU clusters from Google to meet their massive compute demands. YouTube is another piece of the puzzle. It's one of the company's best assets. As you can see through this graph from Nielsen, just accounting for TV usage, YouTube beat out Disney and Netflix and is clearly at the top. When comparing YouTube to Netflix, YouTube clearly wins out on every single category. This is a societal shift in how media is produced and consumed. Netflix and YouTube have very similar annual revenue. YouTube is roughly 36% more profitable, For every user that Netflix has, YouTube has over 4. YouTube gets twice the watch time as Netflix every single day. Not included in the revenue stack is YouTube Premium subscriptions, which is roughly $10 billion per year. We don't actually know the profit margin on that, but you can guess that it's going to be pretty good. Netflix has a current market cap of about $350 billion. After a sell-off, previously it was almost $500 billion. If YouTube was a standalone business, it would likely be valued at over $500 billion, and it's showing no sign of slowing down. YouTube won the streaming war. YouTube will become a $1 trillion asset. Waymo, while still in its infancy, is telling a very similar story to the rest of Google's products and services. This is a company that likes metrics that go up and to the right. We don't actually have the quarter-by-quarter information on this one, but the updates that we do get tell a very healthy story. They're winning in robotaxi. There are constant updates of the service going live in new cities all the time. It's 10 times safer than human drivers and has the potential to make taxi services much cheaper for the consumer. Whether you love it or hate it, the future of transportation is automated, and Google is leading the charge. Bank of America projects that the autonomous vehicle market will be $1.2 trillion by year 2040. If Google just captures 20% of this market, that could be up to an additional $250 billion in revenue each year, more than half of what the entirety of Google did in 2025. And finally, we get to search, the core business the market believed was dying in 2022. As you can see here, it has only grown since then, and it's showing no signs of slowing down. Google Search is more powerful than it ever has been, and it's now infused with one of the most powerful AI models that Google itself owns. Every metric shows a very healthy company that's thriving, and really always has been, even if the market has thought otherwise. Looking at all of this data, it's pretty hard to make a case for a bad future for Google. But what else is the company planning for? What foresight does the leadership have that we're currently not seeing? Google is currently working on healthcare analytics tech, drone delivery, and internet infrastructure. On top of that, Sundar Pichai, the CEO, has started talking about Project Suncatcher, a space-based data center constellation. Considering that Google currently owns about 7% of SpaceX, it's not a surprise that they're looking at expanding into space. If this works, it could potentially lower the cost of AI compute by 10 times. That's not bad considering that they've already cut costs by about 50% by using their own TPUs. They're investing deeply into agentic AI for complex business processes done by AI agents. Most impressively, in my opinion, though, is their R&D into quantum computing. Google showed the world in 2025 that quantum computing is possible and that they're not going to give in to NVIDIA's estimates of a 20-year time horizon for when quantum will be finally commercially available. Google is shooting for year 2030 to make this a thing in the market, and that could fundamentally change the stage for compute once again. As I said before, it's impossible to tell the future, but extremely advantageous to find the signal through the noise. When looking at how Google came back from the grave in 2025, the answer was actually there all along. All of the data, the leadership, the employees, the economy, and the market trends quietly showed an extremely healthy company with an impeccable track record and a uniquely bright future. All the while, social media influencers, competitors, and market analysts screamed from the rooftops that the company was a sinking ship and you'd have to be an idiot to stay invested. None of this is financial advice, but by looking at what happened with Google in 2025, I can't help but think about how many other great companies there are in the world that are trading lower than they should be because of a false narrative, and how recognizing that false narrative can make a wise and patient investor a lot of money. In my case, Google was my first big win in investing. After the April 2025 tariff threat lows of around $145 per share of Google, I started to recognize a pattern here. It was actually Joseph Carlson who brought it to my attention. I started buying shares of Google at $180, and my last purchase of the company was at $278. At the time of recording, my investment in Google has made me $24,000 in profit. That's if I sold today, which I'm not planning to. This is a company that I don't want to sell. When choosing a company to invest in, I want one that I can hold for decades, and Google fits that strategy to a T. It's not usually wise to invest in a company that needs to have everything go perfectly in order for it to grow. Google will likely grow at a very steady and market-beating rate if we just stay in the status quo. If it keeps beating earnings like it has been, or if the future moonshot bets work out, then it will be an extremely good purchase. If you enjoy this kind of content, please stick around. My goal is to make my current and future videos as factual and entertaining as possible as I analyze companies and try to provide value. I'd love to have feedback in the comments to know how I can improve and make this content better for you, so let me know.